Hi, welcome to my video on the fundamental building blocks of wealth. We start by looking at wealth protection, peace of mind wealth, lifestyle wealth, retirement wealth, and estate planning. So let's look at each of those in more detail. You're being presented to today by myself, Catherine Smith. I have a number of degrees including accounting, financial planning, taxation, mortgage broking, real estate, to name a few. I'm also a passionate property investor for over 20 years. I've bought and sold in most states of Australia. I've also done share market, derivatives, trading, insurances, mortgages, you name it, I've done it. Having said that, the information I'm about to share with you cannot be taken as personal financial advice. You should seek that before you take any action. So what's wealth protection? I consider this the building blocks, the first building block. So many people focus on building wealth without actually protecting wealth. Different types of insurance: income protection insurance, life insurance, and trauma insurance, also total and permanent disability insurance. So why focus on insurance? It's always a difficult conversation to have with a client, but it's necessary. We generally don't think twice about insuring our home or our car. We may pay a premium of $1,500, $2,000 a year to protect an asset worth maybe $50,000 for your car, maybe $500,000 for your house, just as an example. But you need to insure the very asset that allows you to buy those things, your income. Your income, actually extrapolated out over the rest of your working career, is worth millions. Yet people don't want to pay that $1,500 to $2,000 a year premium to insure it. It's madness. You need it, because 1 in 3 can expect to suffer an accident or illness and have 3 months of work. That's 1 in 3. Who needs it? Employees and the self-employed. Let's look at it. Your choices. You could have 100% of your income. As in, you don't have your insurance. You become sick, you get no income at all. Compared to having 98% of your income, so spending a little bit of it on income protection insurance, you become sick. You've now got 75% of your income. You would be surprised to know actually how many of my clients I have seen in the situation of, yes, either having it and having a reasonable time when they're off sick or had an accident, and those who don't get financially devastated by it. It's a very simple, cost-effective way. But next is life insurance. Very simple, cost-effective way to provide for family lifestyle, outstanding debts and funeral costs, and in business, to protect the key person in the business and the remaining partners. So it's not nice speaking about life insurance. It's basically, it used to be called death insurance. They've changed it to life insurance. It sounds a bit better, but it's still the same thing. You get it when you die. Why is it important? They're very simple. They're quite cost effective. You can also do them through super, which becomes even cheaper. Do be aware of accident-only policies, where it may be very, very cheap, but it protects you only if death in an accident, which is extremely rare. It's much more likely you'll die, unfortunately, through sickness. Why is life insurance so important? I have seen families absolutely devastated. The main breadwinner, or even the non-working spouse, unfortunately dies, and the remaining spouse cannot keep the house anymore. The family, in a time of absolute grieving, the family are also in major financial distress, losing their house, having to find somewhere else to live, having to start all over again, simply because the partner didn't have life insurance. Once again, that's madness. It's a very cheap, effective insurance policy to have. Trauma insurance, also known as total and permanent disability, slightly different insurances, but still worth considering. Trauma gives a lump sum upon diagnosis of medical conditions. 93% of all trauma claims are cancer, heart attack, coronary artery surgery, and stroke. So who needs trauma insurance? Once again, everyone. It's not just the breadwinner, because often if people just protect the breadwinner, but then the spouse, who may not be working, thinks they don't need it. But if that spouse has an accident, illness, etc., and can no longer, say, care for the children or do the household duties, often the breadwinner will have to take time off work to do that. Also in business, it can protect small business, smooth out ripples if a partner is struck down, and you can ensure you keep people. So why do you need it? You may have income protection insurance, which is fantastic. That will pay. But it won't be enough. If you have a serious trauma with serious medical condition you may need medical surgery perhaps done, you may need modifications of the house, etc. It will also, income protection will also normally only last either 5 years or till 65, depending on your policy. You have life insurance, that's hopefully you do, and that may be enough, but it's not going to pay until you actually die. I actually believe total and permanent disability and trauma insurance is more important than life insurance. You should have both. But if you had to choose, have the one that covers you in the middle. Because let's face it, wouldn't you prefer to have some money whilst you're still alive to help you cope with what's happening, rather than just waiting for it to come after death? Okay, that's done, and I'm glad that's done. It's not a very fun topic to talk about, but it's necessary. You need to protect your wealth. The next type of wealth we're talking about is peace of mind wealth, also using an offset account. So peace of mind wealth is having some savings, obviously. Where would you put those savings? You could put them in a bank account and earn, say, 2.5% to 3%. Or you could have them in an offset account. Basically, an offset account offsets your mortgage. So it saves you up to 5.5%, 6%. And you're not taxed on it. Basically, the amount held in the offset account offsets your home loan and reduces the amount of interest you pay. You don't pay tax on the interest. Very simple to operate. 24 access via internet or phone. So how an offset account works. We look at having your salary and wages. We look at putting part of the salary and wages into a bank account for your monthly budget, bills, living expenses. The remainder amount, and I always suggest 10% of your income. It's called paying yourself first. So take 10% no matter what you earn and put that into the offset account and save that for peace of mind wealth. Also, if you have any investments, investment properties, shares, dividends, etc., they can also go into that offset account. So, an even more better strategy, a way of doing it, is to have all of your money go into the offset account. That's going to actually greatly reduce the life of your home loan and the amount of interest you pay. The danger in it is only for those for good with budgeting. The way it works is you put all your money and your investment income going into the offset account to offset your home loan. You pay all of your bills and all of your living expenses on a 60-day interest-free credit card. At the end of the month, the credit card is repaid via a direct debit of the offset account. Very simple to use. I say it's only good for those with budgeting, and I have had many clients use this strategy effectively. I've also had some clients not so effective, because that Visa card can be dangerous. You might just buy this and want that and see this and take that and buy this. In other words, your cost of living is actually going up because you're spending things because you've got a Visa card. If you're that type of person, don't do that. Go back to the last example, where you simply have 10% of your income going into the offset account and having everything else in a budget going into a bank account. Okay, moving on from that. Next thing to look at is having a regular investment plan and using gearing. That's called lifestyle wealth. So you've got your peace of mind, so you've got your basic saving in a bank account, which you need. But now let's move on. If you want more than that, if you actually want to have a good lifestyle, let's have a look at a regular investment plan. Very simple and effective. Just requires discipline. It's a great strategy to build wealth, and it takes advantage of market swings, also known as dollar cost averaging. Lifestyle wealth. Okay, let's have a look at this. So in this case, we are taking the plunge and saying you can budget, so let's use that Visa card, interest-free strategy for all your bills and expenses. You've got all your salary and wages, going into the offset account. All your investment income going into the offset account. Building peace of mind wealth and having it offset your home loan. What you're going to have now is 10% or more of that coming out into a regular investment plan into shares or property. How does that work? Well, let's look at gearing. Gearing, basically borrowing funds, increases or decreases your investment opportunity. In other words, it magnifies gains. It also magnifies losses. So it's a long-term investment strategy. Shares and property go up and down, some more than others. The share market has been a particular roller coaster at the moment. Property has certainly been a more stable long-term investment. But If a gearing strategy is going to magnify gains and losses, it's important that it's a long-term investment strategy, a 10-year period, because over the 10 years we see both the share market and the property market average out to a long-term gain. So a negative gearing strategy is where the income is less than the interest. In other words, you're making a loss. That loss can be claimed on your tax return. A neutral strategy is where income and interest just offset each other. We're seeing more and more in the property market at the moment, property investment strategies being neutral, simply because rates are so low and rents are so high. Positive gearing is when income is more than the interest. And we do see that in the property market as well at the moment, where you can buy positive cash flow properties where that income is far more than the interest. But let's look how it works. To get into gearing, you need an asset backing, be it either property or shares. You can use instalment loans, margin loans, or mortgages. An instalment loan. Instalment loan is we establish a loan facility, generally with some of the major banks. And you pay an amount in instalments. Generally you need $1,000 to get started. And then you might contribute, say, $250 a week, a fortnight, a month, depending on your affordability. The benefits of the instalment loan situation magnifies the gains and losses. It's called dollar cost averaging. Too many people focus on, should I buy now? Should I buy now? Should I wait? Is the market up? Is the market down? What an instalment loan and dollar cost averaging does is you're putting the money into the market regardless of whether it's up or down. What happens over time is that you're putting some in when it's down, some in when it's up. It averages the price that you put into the market. We have a saying where we say it's actually time in the market rather than timing the market. In other words, put the money in and leave it in there for the 10-year period is better than trying to jump in and out whenever you feel the market is worth buying into. It's a long-term strategy and it's very tax effective. Margin loan is similar. We borrow the funds to invest into equity, which is shares, managed funds. They're used as security. This was many people's unbecoming in the GFC, called margin calls. If the shares drop in value, the bank will want more money off you. If you don't have that money available, they can wind up the whole portfolio. Generally, the minimum loan is $20,000. Once again, it magnifies the possible gains and the possible losses. So it's absolutely wonderful when the share market is improving. It can be disastrous when the share market is diving. Once again, it's a long-term strategy. And it's very tax effective. Let's have a look at property on the other hand. I always say property is as safe as houses. It's bricks and mortar, it's tangible, you can see it, you can feel it, you can touch it, and it is needed. It is necessary. We have a chronic undersupply of property in Australia, and I have plenty of other videos on that topic, so I won't go into great detail. Having said that, just to point out that the average long-term trend on property is 10%, property doubling every 7 to 10 years. So why property? I actually have another video on this topic where I talk about how property outdoes shares by more than 300,000 in only 10 years. You can duplicate property, you can build a property portfolio much faster than a share portfolio, because as the property goes up in value, you can use the equity to buy another one. Once again, there's another video on that topic. You can also pay no capital gains tax on a property held for the long term, saving hundreds of thousands of dollars. Once again, we can have a video on that topic to let you know more. Okay, so we're back to building our fundamental building blocks. So now we have the income coming in into the offset account. 100% of the income into the offset account. Putting your expenses and bills on a Visa card that gets paid every month. Putting 10% or more of that income into a regular investment plan, shares or property. So out of that account comes the monthly direct debit for the instalment loans or monthly direct debit for the property loan. What happens with property at the moment is that a lot of them are cash flow positive, so actually even won't be paying it out of your own pocket. But if it is slightly negatively geared, maybe by $50 a week, it can come out of that account. So we've looked at building lifestyle wealth now. Now let's look at retirement wealth, superannuation. Superannuation is the best, well, it's the primary source of retirement wealth. It's also the best source of retirement wealth due to the tax. Let's have a look. We need retirement wealth because the wave of the retirees, the baby boomers, are all starting to retire now. The government has quite openly admitted that as all those baby boomers retire, we're not going to have enough taxpayers left in the system to pay enough tax to fund their retirement. In 1991, we had more than 5 taxpayers per retiree. By 2031, they're saying we will only have 3 taxpayers per retiree. In fact, the statistic I read earlier is that we'll only be two taxpayers for each retiree. The government simply doesn't have enough money, and they're actually openly admitting that now. And life expectancy, and particularly going back to the insurance that I started with, life expectancy it has increased dramatically. People are now living into their 80s and 90s and beyond. So you need more money behind you when you retire so that you don't run out of money. So the average life expectancy now in 1996, this is a bit old, but we have females at 81 and males at 75. I do believe that has actually gone up since then. So who will fund the retirement strategy of you as you're getting towards retirement? There's less funding pool available. You need to be self-funding. And let's look at how. Firstly, let's look at why. The Fitzgerald report basically says that have they looked into it and they analysed retirement strategies based on the government laws at the moment, the 9%. Even if you put in an extra 3% yourself, for 40 years, you are still not going to have enough. That will give you, if you put in that, and most people don't, most people are only getting the 9%, but those that even are salary sacrificing a little bit extra and do it for a whole 40 years. Most people don't do it that long because the females might have time off for children, etc. Even if you do that, you will only have 40% of your pre-retirement income, meaning that if you're earning, say, $100,000, you'll retire on $40,000. So that basically, superannuation guarantee is not enough. So when do you wish to retire? It's unfortunate that we have about more than 20% of 65-year-olds needing to continue to work after retirement. So superannuation is very important because of the tax effectiveness. Companies pay 30% tax. Wage earners pay up to 48.5% tax. Super, you only pay 15% tax. Once you're over 60 and in pension is 0% tax. I help a lot of my clients basically, by the time they retire, have all of their wealth, all of their property in the superannuation system, completely tax-free. So there's some ways to help is consolidate your super. Call the Lost Super hotline or go to the government website, tax office website. Invest in long-term investments, growth assets. 10-year plus life cycle for most investments. Look at properties and shares. You can watch our video on how to buy property in superannuation. So salary sacrificing is another important thing to consider to add to your retirement planning. Salary sacrificing is basically tax-effective contributions into super, into a concessionally taxed environment. You can save basically your tax rate, put it into super and only pay 15%. Gives you the power of compounding. The more you put in, the sooner, the more it's going to grow. Okay, so now we're back to our building blocks. So now we have your income going into the offset account, Visa card paying your bills, amount coming out for your retirement, regular investment plan, growing a share and property portfolio, looking at retirement wealth, putting more into super via salary sacrifice, or using self-managed super fund to buy property. So, now that we've done all that, we're now basically giving you some pointers to have peace of mind wealth, lifestyle wealth, building retirement wealth. We need to look at estate planning. once again, I guess I started with a negative topic being insurance. Now I'm ending with a negative topic being, okay, what happens when you die? But once again, it's a very important thing to consider. You don't want to build all this wealth simply to lose it to the taxman when you pass on. You want to very effectively pass it on to your beneficiaries. But there's too much to say on this topic. We have a separate video altogether on it. Suffice to say, I will say, anyone with any wealth to protect and beneficiaries should be using a testamentary trust. Speak to me or speak to your solicitor lawyer to make sure you've got that in there. It's a very simple thing to put into your will that you want a testamentary trust established. It saves hundreds and thousands of tax for your beneficiaries. So let's put it all together. What if one firm could help you with all of these needs? Holistic Financial Solutions can. I am also a wealth coach. What is a wealth coach? We'll talk about that in other videos. So other videos we have, properties versus shares, which is best? Why property, how to grow a portfolio, property investment strategies, land tax and properties, finance strategies, tax and rental properties, tax and property development, ownership structures, positive versus negative gearing is a very controversial topic as well, and how to build a portfolio with passive cash flow of $50,000 per year with only $20,000. So as I said, with wealth coaching, seriously consider our wealth coaching packages. We have a wealth breakthrough package, a holistic wealth through property package, and a holistic wealth through business package. Simply contact myself for further information, Catherine@wfscanberra.com.au. Thank you for listening. We have a saying that I like to finish all of my videos with. Life is a challenge, meet it. Life is love, share it. Life is a dream, realize it. And life is a game, so play it. Thank you for listening, and I hope you will listen to some of our other videos in this series.